Risk Management 101, how to trade smarter and more profitably. Welcome back to another Conquer FX webinar. As you can see in the title above, we're going to be talking about risk management, the basics of risk management, how to assign risk to different setups depending on the probability of that setup itself. We're going to be talking about finding your sweet spot so that you're not risking too much, that you are emotionally attached to the trade, but that you're not risking too little, which usually results in you trading movement rather than opportunity because you do not care about the result. I want to show you how to find your sweet spot depending on your personality trait, not just the fixed 1% that people will tell you to trade on a day-to-day basis. I also want to talk about what is risk in general, and we'll talk about different things throughout this webinar that will help you when it comes to risk management, because I believe risk management is so much more than what we see across social media in general. So this quote here, Steve Burns, is very similar to what we hear from Mark Douglas, that the majority of short-term trading results are just random. In the long term, the money ends up with those that can trade and manage risk. Now, this is very similar to what Mark Douglas says about that there's a random distribution of wins and losses throughout our trading career. In other words, that over your next 10 trades, you could have win, 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 loss, 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 win, win, loss, or whatever it may be. And basically what this means is that we do not know when the next win or loss is going to come. So what we need to do, once again, just like the last video I uploaded, is focusing on things that we can't control, bring it back to things that we can control, which is really looking into how we perform as a trader. So when it comes to risk management, when it comes to the random distribution of wins and losses, our job when it comes to performance is to just execute the plan. When the setup is there, it is our job to piece the ideas together, to piece the stories together, and actually be able to have full confidence behind ourselves to execute that plan while managing risk at the same time. So although the process or the distribution of wins and losses is completely random, we can still develop different frameworks to make sure that when we're going through really great periods of trading, that we're maximizing our trading results. But then also when we're, going through periods of drawdown or consecutive losses or whatever it may be, that we also have an aggressive defensive approach, which we're going to discuss in this webinar. And why do people say trading is a risky business? Is trading really a risky business? Well, I believe, like everything, we have to bring context into the situation. As Warren Buffett says, risk comes from not knowing what you're doing. If you do not have a trading plan, if you do not know how to assign risk, if you are just trading movement rather than actual opportunity that has edge, that is backed up by backtested results, hundreds of data points and everything else, well then of course if you're not trading with these proven historical results behind you, of course trading is going to be risky. If you're in a trade and you're managing the trade but you do not know what action you need to take next, well of course risk is going to come into play, and all of a sudden the game you're playing becomes a lot more riskier than the individual who's treating it like a professional business, who has a plan in place and knows what steps they need to take place when X happens or Y happens depending on the situation or any given day. So when it comes to the basics of risk management, what are the basics? Well, the standard one is you risk 1% per trade. But my whole point behind this is everyone is different. Their personality traits are different. Their experience is different. When it comes to their past experiences of how much they actually fear the market itself, how much trauma did they go through before reaching profitability, or how much trauma are they currently going through? Are they going through a phase where they need to just ease themselves out of this toxic cycle? Well, then someone like that is going to want to diversify their risk, bring it down a lot more, rather than someone who has 10, 20 years of experience, who is confident in their approach, has extreme trust behind their plan and their abilities. Obviously, we're going to assign more risk to that person, if they feel comfortable with it. And this is why I personally feel that risk is a personal choice. Now, that does not mean that you go ahead and start risking 5-10% per trade. No, we still need to be conservative in our approach, but know when we can allocate that higher risk of, 2% or whatever it may be. I get traders on a consistent basis messaging me that they're having problems, with fear, greed, and everything else, that they have problems with patience. When we look at patience, people say, oh, well, I just closed my trades too early. Well, it's not that you're closing your trades too early. People mistake patience for actually not knowing what action they need to take next. It's the same with greed. You're not trading all these opportunities and over trading or assigning too much risk because you're a greedy individual. Human nature is to really be greedy, to reap the rewards of what you believe you deserve. But what greed really is that you want to get out of your current situation a lot quicker than you currently are, and you see the trading as basically a pathway to get there. So you believe by assigning more risk to each trade that you're going to basically get more return from each trade, and that's going to get you out of your current situation, your financial situation, your living situation, whatever it may be. But it all comes down to a much more deeper emotional trigger than most people think. So when we assign risk to a trade, although I think sticking to the 1% risk per trade for beginners is essential, I think as you become more advanced, it's important to basically know when you can assign more risk to a trade and when you should step back and not assign so much risk. Now, that is more of an advanced model. So if you're going to be taking my advice on this, what I would say is that you really need to look into your own ability. You need to be having consistent results and everything else. If you do not have consistent profits, you're not there yet. Let's just focus on you getting consistent. So for all those beginner traders out there, stick to your 1% per trade or whatever you're sticking to, 0.5, 0.25, 0.2, whatever it may be. Then the other side of risk management is knowing when not to trade at all. We have different market phases. That could be the trending market, that could be the ranging market, and that could be basically no clear phase, okay? Whatever this picture is that I've just drawn here, I'm not sure, but you get the picture, okay? You need to know when you're able to trade, okay? When you should be allocating your higher risk model, or when you should just be in the market and when you shouldn't be. If you're trading more of a support and resistance strategy, well, the ranging markets are going to be something where you're going to be able to allocate more risk. They are your perfect ideal ranging markets. If you're trading something with Fibonacci or something like order blocks, etc., where you need aggressive pullbacks into those kind of V patterns or whatever it may be, well, then that's where you're going to be able to allocate more risk. But a trending strategy is not going to allocate more risk to a ranging market. It just doesn't make sense. So it's like bringing a Ferrari down, an off-road track. That's not where it's meant to be. That's not where it can maximize its performance. So you really need to have a very, very clear vision of when you should be trading and when not to trade at all. And this brings us back to the last video of knowing your strategy better than everyone else. Then it comes down to knowing your system for getting out of large large drawdown levels. Do you have a defensive strategy? Do you have a defensive strategy that actually stops you from even getting into large drawdown levels? The deeper we go, the more emotionally attached we become to each trade. Do you even know what drawdown levels you should expect? Over the last 3-4 years of data, what was your largest range of consecutive losses? What was your largest drawdown levels? Because then as you move forward into live markets, you now have more of a buffer to play with. So if your largest drawdown levels were something like 10% and you are currently in drawdown of 6%, well, you know that until you kind of reach this threshold, there's nothing really wrong, that this is just a process of your edge playing out. Now, in order for actually this to play out here, you need a very large sample size. 100 trades is not going to do it. 200 trades is not going to do it. The more larger your sample size, the more accurate your findings are going to be. Next, I want to talk about finding your sweet spot. And when it comes to finding your sweet spot in trading, this is what I mean by truly understanding your own personality, your needs as a trader, what you're satisfied with per trade, but also having the capability of being able to focus rather on performance rather than the P&L on your screen. And being able to find your sweet spot is something that's going to allow you to focus rather on the performance than how much you're making per trade. Because when we're able to eliminate as much emotions that are coming into the process as possible, or basically when we're able to eliminate the lack of discipline because the risk is too small, and we find that part where we care enough about the plan to trade on our performance, Now that's when we're actually shifting all of our focus on the performance rather than how much we're making or if we really care about what the trade is. We have those opportunities where people will just say, this kind of looks like it's going to play out. I'll lower my risk and just get in. Sure, if it wins, it wins. No, I want you to be trading only your plan. I want you to have results that when you look at your MyFX book, when you look at your journal, that your results are not manipulated by your lack of discipline. Your emotions are fixed, that it's all the data there is a result of trading your plan and only your plan. So that the data you have can be easily optimized, will not be manipulated, and is, there's some sort of pattern sequence there that you can spot to be able to optimize further. So when it comes to analyzing your sweet spot or finding your sweet spot, we need to understand basically the characteristics of each trader. So when we look here, so let me just type here. Okay. So we'll call this the sweet spot. We'll call this too much, and we'll call this too little. So the characteristics of someone who risks too little is someone who basically does not really care if it's a win or a loss. Okay, so obviously we don't want to be emotionally attached to if we have a win or loss. If you are emotionally neutral, you have an advantage in the market. But what I mean by too little is that if you see a trading opportunity and you say, well, this isn't really part of my plan, but sure, I can just trade this opportunity because I'm only risking whatever, 0.5, 0.2%. I'll just get in the trade anyway and see what happens. If we win, we win. Great. If we lose, we lose. It doesn't matter. That's kind of careless. That's a characteristic of carelessness. Okay. You don't really care about what you're really doing. You're just trading because either you're bored or you're not really treating this as a professional business. So they're the characteristics of someone that's trading too little. They don't really care about the opportunity. There's no lesson there for them. It's just, hey, this is a gamble, let's take it. Someone who's risking too much is the individual who is emotionally attached to the trade. They place the trade and immediately their hands are sweating, their heart is beating faster, they're getting headaches, they can't take their eyes off the screen, they're watching every single tick of the chart, they fear, anxiety, and everything else. They close out their trades too early, even if they do have a plan, because they're afraid of the market coming against them and what could happen, and they can't really let their edge play out to the full potential. Your sweet spot is the point where you care enough about your plan that you need, or care enough about the risk that you need to follow your plan, but that you accept the amount that you're losing, that if you do lose the trade, you're not going to become emotionally attached and basically use this as an indicator of your own self-worth. So when you can find that sweet spot that you're able to execute it without it actually affecting your view on yourself as a trader and your ability and how much you're emotionally attached to that trade, and still able to just focus, but still care about it enough to focus on following the plan and understand that risk is a real thing, well, that is the ideal trading sweet spot. Now, when it comes to developing metrics to diversify your risk, professional traders, okay, and a lot of the time they will not tell you this, but a lot of professional traders, and I would say this is more so on the day trading side of things, and this is just from my own personal experience. There's plenty of swing traders out there as well that will diversify their risk depending on the setup. But the reality is they do not just stick to a set risk. They have defense systems and aggressive systems in place to be able to make sure that they are basically taking as much out of the market as they can when they're playing well, and being really on the defensive side when they're not playing so well. The reality is you can't reach record returns by sticking to a simple 1% process. You can stick to a consistent, returns where you're just consistently, moving that kind of, we're stepping stones, okay? But if I want to jump from here to here, well then, we need to start developing risk models that when the odds are really shifted in our favor, we start playing the game with a little bit more risk, but still keeping in mind that we have our sweet spot, okay? So When it comes to diversifying your risk, you want to make sure that you're actually at a level that you can do this, that you have the data behind you to do this, that you understand how much risk you're risking per trade, that you understand your defensive system, and that if you are assigning more risk, well then on the opposite side of that, you're going to need a very strong defensive system if that goes against you, to minimize the downside of that opportunity if it goes against you. The process is simple. Like everything else, we want to start collecting data. You want to start collecting data on the different setups. If you have two different entry models, this is a simple way of doing it. Test entry model 1, entry model 2. See if there's a difference between them. If entry model 1 is performing better, well, we can start calling this your high probability model, while this is your lower probability model. If this model is bringing in, if model 1 is bringing in more rather than model 2, well then we know how to assign our risk, and this is how we can start maximizing the return on our trades. The trick is to not find the golden strategy. The trick is to find the golden nugget within your own current strategy, because every strategy can make money. It's just about how you optimize it and use the information in front of you to basically maximize your returns. So by understanding your stats, by assigning the risk accordingly, we can maximize our returns over time and really reach the full potential of your strategy and also your trading performance. So overall, guys, this is just a quick breakdown on risk management. Next week, we'll have some more YouTube videos for you. If you really enjoyed this video, I would really appreciate if you can just like, comment down below and subscribe to the channel. It would really be a huge, huge help. I'm looking forward to seeing you in the next video.